I'm going to begin my talk with a joke. I seldom do, but this one seems so pertinent to what I want to talk about that I couldn't resist. It's a wonderful joke. Sherlock Holmes and Dr. Watson were on a camping trip. In the middle of the night, Holmes wakes up and gives Dr. Watson a nudge. "Watson," he says, "look up at the sky and tell me what you see." "I see millions of stars, Holmes," says Watson. "And what do you conclude from that, Watson?" asks Holmes. Watson thinks for a moment. I'm going to shorten this up, but you'll get the idea. Watson thinks for a moment. "Well," he says, "astronomically it tells me blah, 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 blah. Astrologically, I observe that blah, 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 blah. Horologically, I deduce that the time is blah, blah, blah. Meteorologically, I expect that blah, blah, blah. Theologically, I see that. What does it tell you, Holmes?" Holmes sits up and he says, "Watson, you idiot, someone has stolen our tent." This is essentially the theme of my talk. Capital Ideas, the book that was published in 1992, was about theory. Capital Ideas Evolving is about implementation, or how the gown came to town. Capital Ideas was about Watson. This book is about Sherlock Holmes. It's interesting that the book is really about implementation, that similar developments have occurred in economics in general, not just in finance. I read an article recently about the most cited articles in economics and how they've changed over time. And today, the majority of articles in economics that are most cited in other journals are on implementation, whereas 20 years ago they were almost entirely on theory. My book provides a lively demonstration that theory matters, even though theory does not work in the strictest sense of the word, but few theories in the social sciences do. I'm going to summarize the book briefly because I covered a lot of this material in Pasadena in 2005 at the annual meeting there when I had a chance to talk about what I was working on. It's all there in print for everyone to see, which I hope you will do. And I want to explore instead some issues raised by the book that perhaps I didn't develop as far as I would like. The main theme of the book is a very simple one. If you think back of the world before 1952, before Harry Markowitz wrote Portfolio Selection, that world bears no resemblance to the world since 1952, and certainly no resemblance to the world before 1972, when kind of the capital ideas came to a climax with the development of the options pricing model. Today, mean variance is the starting point for leading active institutional investment managers, and diversification is gospel. This was not true 40 years ago, or 50 years ago, or even 30 years ago. Even the scholars of behavioral finance take the efficient markets hypothesis as their benchmark. CAPM, much scorned empirically, is today more alive and well than any skeptic could have foreseen, and I need not elaborate on the impact of the options pricing model. The biggest idea of all, derived from this collection of theory, is that risk is at the heart of all investment decisions, the single most important element that separates the world since 1952 from the world before 1952. When I went to interview Harry Markowitz for Capital Ideas, and I remember he was sitting there, he said, "I read John Burr Williams, who says you have to buy the stock that is most undervalued." And he said, "But you have to think about risk as well as return." It's a thunderclap. Changed the world. Now, I'll give you a bird's eye view of the contents. I'm going to go quite fast because I want to get to the heart of the matter. I confront behavioral finance right up in 2 chapters as a source of alpha. It's the most interesting and important observation is from Daniel Kahneman. I think you have to keep this in mind when you think about what behavioral finance really means and what its subject matter is about. Very important. The interpretation of our work as a broad attack on human rationality, rather than a critique of the rational agent model, attracted much opposition to our efforts, some quite harsh and dismissive. Then Danny Kahneman told me this in conversation. He said, "The failure in the rational model is in the human brain it requires. Who could design a brain that could perform in the way this model mandates? Every single one of us would have to know and understand everything completely and at once." Dick Thaler, Danny Kahneman's leading disciple, but who uses quite different language, put it this way: people are not blithering idiots, but they're a long way from irrational automatons. I'm going to return to this matter in another format later on. My main point about behavioral finance is that behavioral finance is a serious criticism of the rational model, no question, but that it points paths to alpha, and in the end, I think, the work of the of the behavioral finance people is to make the market more efficient because they keep uncovering sources of alpha or paths to look for alpha, and the more that happens, the more efficient the market becomes. The book begins with a survey of a group of theoreticians. There's a short chapter on Paul Samuelson, still going strong at 93, still skeptical of active management, some pretty strong language. Then I deal with Bob Merton, Andy Lowe, and Bob Schiller, all of whom academics deeply into implementation, especially the role of institutions and how to use capital ideas to employ institutions as a means of improving investment performance for individual investors. Very exciting stuff, very novel and brilliant, innovative ideas, but all stemming from the basic theory. Then there's a chapter on three still academics I refer to as the engineers: Bill Sharp, Harry Markowitz, and Myron Scholes, all involved in implementation of capital ideas. Sharp, as I'm going to point out in a little while, has been profoundly revising his views about risk. Not interested in beta anymore, but in Ken Arrow's theories on state preference theory. But Sharp, like all the others, is in implementation because he's in business as financial engines, which provides advice to 401k and other individual investors on asset allocation. Then there's Harry Markowitz, who began our interview by saying to me, "You will be completely surprised if I tell you what I am doing." And indeed I was, because this is a long way from theory. He's involved in the most elaborate computerized simulation I ever heard of, in which he, with Jacobs Levy, are modeling markets under all kinds of different circumstances and playing them out to see how they respond to behavioral quirks. Very elaborate, very interesting, very exciting. Myron is running a hedge fund which he says provides risk transfer services. They seek out opportunities to buy areas in the financial markets that are undervalued because other people are by necessity trying to seek liquidity. We had an ongoing controversy as to whether he's just a smart investor who knows how to find value where he sees it. He said, no, we're not in the alpha and beta business. We're rendering risk transfer services. We went back and forth. I won't tell you how it ended. But in any case, when we add up all these academics, we can surely say the gown has come to town. Then I treat a group of practitioners, BGI, Yale, the development of portable alpha strategies, Marty Leibowitz's new views of alpha and beta, and Goldman Sachs, all of whom emphasize that capital ideas underlie what they do. David Swenson summed it up very well when he spoke to me. He said the basic framework is far superior to anything else that's out there. It is, in short, incredibly valuable. Now I want to extend some of the ideas in the book, or talk about some things that are not in the book. I must say, this is my 10th book, and it has never failed to happen. The instant they put it in your hand and you see the volume, you think, oh, I should have put it in this way. This never failed to happen. Then within days you get letters from people saying you made a mistake on page 48. That I'm used to. I read recently about some professor who encouraged people to let him know where the errors were, because the faster they came in, the sooner he could justify a revised edition. I'm going to discuss two aspects of risk, which is, after all, the centerpiece of everything. Both relate to risk measurement, and thereby to popular methods of risk management. This, I think, is the most important part of what I have to talk about today. The theory of finance revolves around the notion that risk is equivalent to volatility, beta, standard deviation, and so forth. This is the essence of what we use when we try to measure risk, express it as a number. I think, although the critics of portfolio theory criticize volatility as a proxy for risk, I think it has an important role because volatility does get you in the gut. When asset prices are jumping around, everybody feels, what's going on? Somebody knows more than I do. What is this all about? Which way are we going? There is a gut feeling in there, and in this sense, I think volatility does serve as an effective proxy for risk. But measurement in the form of volatility, standard deviation, and beta, and so on, all focus on risk in the short term by their very nature. For long-term investors, with strategies oriented toward buy and hold, short-term volatility is either irrelevant or an opportunity to upgrade and revise portfolios. Put differently, I would argue that the risk measurements associated with capital ideas force investors to focus on the short term, and perhaps that is an unfortunate consequence. The beta and standard deviation are somehow the essence of your view of risk because you can measure it, because you can quantify it. You are locked into short-term thoughts whether you want to or not. Warren Buffett has defined risk as the possibility of impairment of capital, and volatility is not the same thing as that. Bill Sharp, when we talked about all of this, commented that too many practitioners and a large number of the business school professors from whom they learn their trade tend to forget that all asset pricing models, this is a very important point, all asset pricing models are about expectations. And then I'm now quoting from him. How in the world can you measure expectations which are a look forward, not a look backward? Hence, and these are his words, it is dangerous to think of risk as a number. And this is why he's into state preference theory to a much greater degree than to beta. Now, we need the quantification business, but I think this is very important to keep in mind. And I want to go into this a little bit further by thinking about where the risk comes from in the first place. We really don't think about it. Whether there it is, and this is how we quantify it, we've got to have risk management practices and so on. But where does it all come from? When we consider the capital ideas described in theory, mean variance, market efficiency, CAPM, options pricing, Modigliani, where am I? You know whom I mean. The players seem to be making, when you go back, you read this stuff, the players seem to be making their decisions in quiet isolation. They're sitting in little rooms with their computers, doing this and that, making decisions, away from the turmoil that actually goes on in the marketplace. And as I thought about that, I was reminded about John von Neumann and game theory and his view of the nature of risk in the real world. He argued that no man is an island, that the Robinson Crusoe is the wrong model. Somebody isolated and sitting by himself looking at a computer screen is the wrong model for the real world. This is what he says. Crusoe is confronted with a formal problem quite different from the one a participant in a social economy faces. In order to bring the rules of game into, and these are his wonderful words, to bring the rules of the game into the sphere of combat and competition, it is necessary to consider an n-person game in which n is equal to or greater than 2, and thereby sacrifices the simple maximum aspect of the problem. Investing is a giant von Neumann game. Buying and selling is human decisions at work. Combat and competition is what it is all about. Equations cannot always describe the true nature of combat and competition, but that's the business all of us are in. Let's face it, your expected return may be a neat number based on wise calculations, but your actual return will be what some investor in the future will pay you for your assets. The enemy is us, and that makes it a lot more difficult to quantify, or a lot more difficult to rely too much on quantification and a little more on gut. Sharp's observations about the dangers of viewing risk as a number, I think, ought to be taken seriously. And my constant mantra, which I say every speech that I give, like press a little button, we do not know what the future holds. We do not know what the future holds, and that has to be taken seriously. Hence my passion for diversification, which is an explicit statement of our ignorance of what the future holds. Now, rather a different topic, but this is from the book, never fails to impress me, and I sat next to Jack Traynor at dinner the other night after having given him the presentation of the award, and reminded him how wonderful this is. This is in the book. It's a passage from an article that Jack and Fisher Black wrote in 1973. Remember the date, 1973. How to use security analysis to improve portfolio selection. Both Jack and Fisher were convinced that the theories that they were developing, particularly CAPM, had practical applications despite their empirical limitations, and that they wrote this article as kind of a crusade to get the point across. The result that they dared to say there were empirical applications was that they had a devil of a time getting the article published. It finally did appear in Chicago's Journal of Business, but only after a considerable struggle. Just amazing when you think of what was in there. Here is what they wrote. There's kind of a long quote, so bear with me, but I think you will get the idea pretty quickly. Optimal selection, this is selection of individual securities, optimal selection in the active portfolio depends only on appraisal risk and appraisal premiums, and not at all on market risk or market premium, nor on investor objectives as regards the relative importance of expected return versus risk, nor on the investment manager's expectation regarding the general market. Two managers with radically different expectations regarding the general market, but the same specific information regarding individual securities, will select active portfolios with the same relative proportions. In very simple language, they said alpha is portable. Alpha decision is separable from the beta decision, and the risks of each can be managed separately without regard to each other. In 1973, it took at least 20 years before this became an active strategy and something that people made use of, and there were those words mustering in the Journal of Business all that time, telling you exactly how to do it. Two great minds at work, and yet the concept is simple, and once you articulate it, it's obvious. Of all the capital ideas, of all of the ideas in the original book, CAPM has failed most miserably in empirical tests. I recently was in a debate with James Montier of Deutsche Bank, who referred to it as CRAP rather than CRAP, rather than CAPM. And indeed, it has failed miserably, and yet it is the cornerstone of a growing number of active strategies today. It shares with the options pricing model pride of place at the center of sophisticated strategies. Now I'm going to turn to another matter, and that is also touched on in the book, but I think has to be presented here. How do we deal with the notions of market efficiency, which we talk about a lot? Is it or isn't it? Is it getting more so? Can I beat the market? What do I do if I can't beat the market? And yet we know well that markets as a whole go crazy in booms and busts. How can we deal with that? The bottom line is we can't. Paul Samuelson, some years ago, in a letter that he wrote to Bob Shiller, made the following observation. Modern markets show considerable micro-efficiency. And as you know, Samuelson believed that very strongly. But in no contradiction to that, I had hypothesized considerable macro-inefficiency in the sense of long waves in the time series of aggregate indexes of security prices below and above various definitions of fundamental values. Schiller and a colleague named Jung thought they would try to test this out, and they took the hypothesis that in individual securities, the correlation between dividend yield and future dividend growth would be negative. That low yield would mean investors expected high dividend growth, and that high yield would mean that investors expected low dividend growth. And they tested this out, and indeed, they found the correlation was strongly negative. The market is very good in predicting dividend growth. So in this sense, the market is indeed efficiency in a micro sense. Then they took aggregate data and looked at that. And the correlation, I'm sure you're ahead of me, the correlation was positive. When dividend yields in general are high, that's a buy point. When dividend yields in general are low, I mean, this was back when they did this work, they seem to be low all the time. When dividend yields are low, that's a sign that the market is a sale. Modern finance theory is micro at its heart. We can't use it to apply to the market as a whole. The study of the big swings in the market is a separate matter, and the study of booms and busts is a separate matter, I think more folklore than science. But there's an interesting deduction from this, that there is consistency, there is some durability in the patterns of mispricings of individual securities, even though market timing is an entirely different matter. And there's an important corollary from this, too. In theory, if this is correct, that markets that in a macro sense are inefficient in that they misprice grossly on the low side and the high side, then in theory, or that tells us that in theory, markets should be forecastable, that market timing should be possible, because they're too high and they're too low. But just because a variable is forecastable does not necessarily mean we have the ability to forecast it. So it's forecastable, but don't think you're necessarily going to get rich that way. Finally, a point of highest importance. This is not in the book. This is the one that I thought of afterwards and I wish was in the book. I have a chapter or a passage about long-term capital management, but I didn't get the point, and somebody else did, and I'm going to tell you what he did, because this is a point I think that has broad generalization and can be used in other contexts. The book I'm referring to is also a Wiley book and on display around the corner by Rick Bookstaber, called A Demon of Our Own Making. To me, Bookstaber is one of the most brilliant people in the whole risk management, risk thinking area. He has a chapter in this book on long-term. The theme of his book is that financial crises are endogenous to markets. It's in the nature of financial markets to go that way. And so there is obviously a chapter on long-term capital management. They built their risk models, which if you read what they did at the beginning, they thought of everything that everybody in this room could think of and then some more. And they had a model to cover that particular risk. But the models were built on the markets that they knew, the markets that they had experienced. the markets that they had data on. When they opened up for business and entered into the markets that they knew, the markets that they had data on, were no longer the markets in which they were operating because they were there. And as the markets got more tumultuous and the Asian financial crisis came along and LTCM got into trouble, the very fact that they were there almost led to a total national financial breakdown. This is so. When we think about the data that we use and whether it's relevant to the future, this is a very kind of key idea to keep in mind. I describe it as a variation of the Heisenberg principle, that you cannot simultaneously measure the location of an object and measure its momentum at the same time. The process of measurement changes the character of the object. Now, you can generalize this broadly, I think, into the dynamics of financial markets. I'll give you a couple of examples. Are the alternative investments today, into which so many investors are rushing, the same alternative investments that made such high returns for David Swensen when he began in the middle of the 1980s? Swensen moved into this area because it was an uninstitutional investment, and this was how he could seek returns away from the capital market, the public markets, which he was convinced were highly efficient. But what was once uninstitutional today is institutional. It has more elements of beta than alpha to it. It has changed in the process because not just a few people are doing it, but we're all doing it. Now think about the derivatives. Greatest invention in the world for helping cushion and spread risks. But they can in turn become the source of shocks because they become so complex or because counterparties today are not all regulated and supervised institutions. I was interested just before we went out, had a chance to glance at today's Wall Street Journal, and it's a headline article on the front page, precisely what I said. It's a big principle. It's Hegel again. Ultimately, this one comes from Hegel. Quantitative changes ultimately become qualitative. And the world of derivatives today is not the derivatives that Black-Scholes and Merton had in mind when they developed their model. In another variation on this theme, we live today in many ways in an environment of low risk. We have low inflation, we have globalization, lots of balancing forces, liquidity available, all this. We're in a period of relatively low risk. But if we're in a period of relatively low risk, and therefore low expected returns, and this induces investors to take higher risks, which they feel they can do because we're in an environment of low risk, are we in an environment of low risk? I'm just not providing answers to these questions, but that this is a line of thought which I got from reading Bookstaber's book and the LTCM story that I think is worth keeping in mind. Don't be mesmerized by the models and think beyond into how the world has changed. My favorite description of being mesmerized by a model happens to come from Adam Smith. This is just wonderful. He says that people who are mesmerized by this, he said, there is no break, no stop, no gap, no interval. The ideas excited by so coherent a chain of things, seem, as it were, to flow through the air of their own accord, without obliging it to exert itself or to make any effort to pass from one of them to another. He had it. I'm going to end as I ended the presentation I made in Pasadena 2 years ago. If we say the theories and capital ideas are obsolete, then in the same breath we must say that Aristotle and Euclid are obsolete. They are very much alive. And we cannot understand the investment process in the present unless we know where it came from. And it came from these ideas, which I think are one of the great intellectual leaps in history, composed in a brief period of 20 years in the ivory towers by guys, some of whom never owned a share of stock in their lives. And as I say in the final sentence of the preface to the new book, working on this project has been a great adventure and a rare privilege. Thank you. Be happy to answer your questions.
Copyright 2007, CFA Institute. No part may be reproduced, stored in a retrieval system, or transmitted in any form or by any means, electronic, mechanical, recording, or otherwise, without the express prior written permission of CFA Institute. This program is designed to give accurate and authoritative information in regard to the subject matter covered. It is distributed with the understanding that CFA Institute is not engaged in rendering legal, accounting, tax investment, or other expert advice. If legal advice or other expert assistance is required, the services of a competent professional should be sought.